So Nehemiah Richardson has decades of experience at some of the globe's most prestigious financial institutions. Well, now he heads up Pengana Capital's Global Private Credit Division, and he's pretty passionate when it comes to product innovation to open up, as Frank was saying, previously hard to access asset classes to retail investors, like Pengana's high-yield fixed-term account platform that's called Term Plus. So the difference here is that it's exposed to global private credit only. I sat down with Nehemiah a little earlier on and asked about global versus Aussie private credit.
A lot of what you hear about the industry here, more generally, there's a lot of sort of, I call it apples and oranges, okay, where you have comparisons that actually aren't really relevant. And so in that context, I'll highlight the differences. Okay, so what you have in global markets is really since the GFC, banks have exited significant segments of lending to corporates. Okay, and that's really been driven by increased regulatory costs that were a result of what happened in the GFC. What you actually have in Australia is, fundamentally different response and different market structures. So the implication of what happened in the US and Europe is that banks withdrew substantial amount of capital from the market for companies that were sort of, $500 million to a few $1 billion in market cap, who all of a sudden could not access credit. Okay, and they weren't large enough, or it was too costly for them to go to fixed income markets or traded credit markets. So the result was a bunch of private credit executives set up private credit firms funded by institutional money, so insurance companies, pension funds, to lend into those corporates. Okay, and so then the implication of that is today you'll have about 85% of corporate lending in certain segments of the markets, like the one I identified, are done by private credit firms, 15% by banks, and that structural gap continues to grow. So when we talk about private credit, we're talking about where the structural gap exists, where there's very limited sort of availability of capital for corporates to find loans. And so they therefore go to global private credit managers for that money.
That's so interesting. So we don't have, first of all, an oversupply of companies in that range.
Correct.
And so when you are thinking about global private credit at Pengana, are you thinking US? Are you thinking Europe? Where?
Yes. So we're thinking US and Europe,
okay,
because that's where you have that phenomenon.
Okay.
All right. In Australia, it's the reverse. It's 90% is provided by our banks and 10% is provided by private credit. And so what you'll then find is the bank, where private credit is playing a role in the intermediation of credit in Australia, is where banks don't have the risk appetite to lend, which is why you see a skew to sort of commercial property. You see a skew to subordinated positions in asset-backed vehicles. So non-bank lenders in this market will fund themselves with the large ones will fund themselves with senior security or senior facilities from a bank, and then subordination will come from the private credit industry. And then the third capital will be, generally speaking, very large transactions that have been syndicated. So your high-profile PE type transactions.
Okay, so it's fascinating.
So very different in the US and Europe.
Yeah, very different. And is that sort of as far as you'll go at Pengana? I mean, is there sort of a burgeoning market? And forgive my ignorance if you look to some developing countries.
Yeah, so we basically are only going where you have long-standing managers who have demonstrated performance, through cycles, and where there's a structural gap. So we don't play really here in Australia because it's very different. And we don't feel like we're providing, the service we provide, I guess, for investors is providing diversified access to that asset class in the US and Europe. We don't see that there's market failure here in the ability for people to access that 10%. And we don't really go and develop markets simply because, or developing markets, because the risk profile is very different. The structural considerations are very different. A lot of times the legal frameworks aren't really friendly for credit lending. So you don't actually have provisions that allow you to grab security very easily and with comfort because of the legal framework for creditors. So lenders. So that's why we avoid those. And I think we'll always stay in the US and Europe as long as that structural opportunity exists. And we see that as being a phenomenon that should go 10, 15 plus years, given what's actually happening with regulation and the amount of assets coming out of the banking sector and going into private credit.
Okay, so when we think about why now for an Australian investor to get into global private credit, I think we understand where the opportunity lies now.
Yeah.
But what about where we are in the cycle?
Yes. Okay, so I'd say the first and most important thing I'd say is that when you're in a situation where you have, like we have as a country, and most developed countries share the same, you have a lot of investors who are exiting or coming to the end of accumulation and going into decumulation phase. And so within that, people are finding, and in a world that's inherently more volatile, so traded credit markets are very volatile, equity markets are very volatile. A lot of investors need stable income, low volatility, really good capital preservation characteristics. So just prima facie, if you then look at it, where do you get that? Well, you can get that with senior secured loans into defensive companies that are acyclical, with really good managers who have a demonstrated track record of investing in the senior part of the capital stack and delivering returns through cycles. So I look at it and say it's not a asset class that you can easily just sort of pick and choose when you want to go in and out of, right? Because it's relatively illiquid. What you want is diversified access to managers who are playing in the senior part of the capital stack with companies that are very defensive in nature, with lots of equity cushion, and managers who have the ability to, and proven ability to deliver those returns. So there is no real, I don't look at it as, is there a real time to invest? I look at it as it's a structural opportunity where you get those characteristics with a big supply-demand gap that underpins additional return over what you would otherwise get for that risk. And you have no volatility or very limited volatility. So it's a really good defensive thing to put in your portfolio as you're entering into retirement or in retirement.
Okay, so you answered my next question, perhaps, with the ideal investor, stage of life.
Yes.
So this is not, high growth. This is not high risk. This will be giving you a monthly income as well as the diversification.
Okay, but the one thing that's also unique about the asset class is the diversification of strategies. So for the most part, I would say if you're looking for those three characteristics, right, great asset class. But given its size, its growth, and because of that withdrawal, there's become this massive proliferation of different types of strategies, which go from senior secured contractual income, but also you can invest in what they call credit opportunities managers that will get you an equity-like return on your investment, okay? The liquidity profile of those funds is very different to a senior secured lender with a big portfolio just earning income, but these investors will use senior secured positions to then recapitalize a company, and they get a super return on their debt, and they'll get cheap warrants or options on the equity of the company to create a super return. Mm-hmm. So for the most part, I would say it's a defensive asset class at the contractual end, but depending on what your objectives are as an investor, you have the opportunity to go low risk, nice income, higher risk, higher income, lower income, more liquidity, higher returns, less liquidity. Does that make sense?
Which one is Term Plus?
Yes, so Term Plus. So what we love about Term Plus is we've created a product basically out of a master portfolio, a very diversified portfolio of global private credit assets. So we have over 2,000 loans within the portfolio managed by 19 different managers across the US and Europe. Now, the reason I raise that first is because it's a highly diversified portfolio, and it was actually designed to ensure that we had very limited concentration risk. And so with that many, there's not one loan or one manager that could fall over that would have a material impact on the net return of the portfolio. Okay, and that's why we structured it that way. And what term accounts are, or Term Plus is term accounts of 1, 2, and 5 years, where we pay a floating rate return over the RBA rate. So for example, our 1-year term is RBA plus 300 basis points, so 7.1% today. Okay, and we wanted to create something that could provide very diverse access for people who had very specific needs of term income. Mm-hmm. Okay, and the additional thing that we did within that context is we have additional protections that we have for those products or for those terms. So for every dollar that a client will invest in a term account, we actually co-invest with the client, and we'll invest 5 cents of every dollar into the portfolio. Okay, and that's really to provide two enhanced protections to investors. Okay, one is there's a priority income entitlement that we give to investors. So what that means is the income that we would earn over a 12-month period is used to top up any shortfall that may occur in the yield that we would pay on the term account. The second thing that we do is at the end of the term, if for whatever reason there was a reason why we couldn't pay you 100 cents on the dollar, we would actually top up your capital to a certain amount depending on the term account that you chose. Okay, so you get a widely diversified portfolio, you have income across different durations, and we provide some additional protections for those investors that are looking for that type of, that type of asset.
Really interesting. It sounds to me to be very unique in the Australian market. Talk to us a little bit about that.
Yeah, so I think having something that gives you diversified access to global private credit in the way that we've done, extremely unique. Being able to provide the terms off the back of a portfolio like that, extremely unique. Getting access to top-rated managers around the world, because we partnered with Mercer, right, in this. And the reason why we've done that is because they have a very significant global private credit platform that advises, researches, rates, and actually invests in private credit, global private credit. So what you have is access to these top-rated funds, many of which you can't actually easily get access to or get access to it all as a retail investor, right? But in a diversified format. And I think putting that whole package together is unique, because I don't know where else you can actually find that sort of diversification in a global private credit portfolio.
Yeah, really fascinating. So how do you open a Term Plus account? And do you have to commit right from the beginning to that 135 year, or how does it sort of evolve, or you see it evolving with the client?
Yeah, so the way it works is, I think it's very much, if you feel like you have a need or you have an interest in any of those terms, right, it's very easy, because you just go to Term Plus. We have a separate website for it. So you go to termplus.com.au, all the information that you need, your PDS, your TMD, lots of educational material on global private credit, what it means, what the risk reward is, et cetera. And I think from that, you can very easily, as an individual, within 2 to 3 minutes, you can actually open an account, because we leverage a lot of, the call it, I guess, hardware that's been put in place over the years in Australia to allow for, really easy access. So AML, KYC, all of those things, and identification that allows you to invest quickly. So I would say go to the website, look at the information that's there, the term that actually fits what you're actually trying to do, and then it's a very simple, quick, and easy sign-up process and settlement process into your account.
Okay, so those are the nuts and bolts of Term Plus, as well as global private credit. I've got a few audience questions, if you don't mind, that have come in. And I think this one is probably on the mind of a lot of people, from Barbara. Do you have a view on whether the Trump administration's focus on drastically reducing U.S. debt will have a positive or negative impact on the U.S. private credit market?
Okay. So the reason I hesitate is just, every day there's something new that comes out, right? That's a relevant question for the whole world, not just the U.S. But I think specifically what the Trump administration is trying to do when it goes to that question is they're trying to reduce the long-term rate by reducing borrowing, okay? So I think if they achieve that, and they're able to achieve, say the 10-year treasury as an example, if they can achieve a rate that's lower than what it is by reducing the amount of debt, because at the moment there's a big concern that as debt increases, the U.S. will have trouble rolling that debt, and they'll have to pay more interest, so you'll have a massive tightening in the economy. So if you're managing the long-term rate to go down, and some of the things that they're actually trying to do structurally, then that should be net a good thing, because long-term rates are low. That's a benchmark for a lot of lending, and therefore it creates the capacity for more investment, in the economy, right? And it alleviates pain for a lot of people because of that long rate.
What about the deregulation point for Trump? Like, how will that sort of impact potentially the opportunities that are on offer for those private credit managers?
I think the deregulation, for the most part, from my perspective, is actually a feature that's much more significant at the very top tier of banking. Okay. And so what I mean is, I hear a lot about the concerns that deregulation will mean that the structural gap gets eliminated, right? Which I don't think will happen. I think what will happen is it just makes it easier for the big end of town, which already has to recycle capital. It'll make it easier for them to actually pick and choose the loans that they want to write. I think if you go to second and third tier banks in the U.S., which are really have been the focus of the regulation since the GFC, I don't really see much changing at all, and I see the gap continuing to grow.
Mm-hmm. Okay, interesting. For Neil, investors now have access to private credit across products like ETFs, listed funds, SMAs. What is the benefit of unlisted products which have minimum investment levels and are often illiquid?
I think, well, the benefits of an unlisted product are really that the product doesn't trade. And I think it also depends on what unlisted product you're investing in, okay? Because you have to look at what are the redemption requirements, what are the liquidity requirements. So for example, at the most extreme end of illiquidity, you'll have a closed-end fund that has a 4-year investment period, say 7 to 8 year life, sometimes up to 10. And those firms will take up to 4 years to invest. They won't pay you interest over that period, and you'll get a lot of capital back at the end. Okay. On the other hand, you can invest in other unlisted vehicles that will provide you with monthly income, and they'll provide you with redemption windows every quarter. Okay. And so within that context, you get a low return, but you have a better sort of liquidity profile, if you will. And we try to create ourselves different products that allow that to happen on a diversified basis. And we also offer a product which is a listed product that also has a quarterly buyback mechanism that effectively replicates the income side of those unlisted firms, where you're putting money in and you're taking money out every quarter by redeeming.
And what's the response been to Term Plus here in Australia?
Yeah, so the response has been actually very positive for a product that we've taken a lot of time to. We haven't spent a lot of money marketing it widely, because we wanted to make sure that we got the actual onboarding engine, using sort of fintech technology, making sure that we got that right. So if we have a massive amount of volume, we're not actually going to have problems originating or closing customers. But if you back that out, we have over the last year spent a lot of time kind of marketing it to our own investor base and a little bit more widely from there. And the response has been quite fantastic, right? Because people really like the opportunity to have 1 or 2 year money in particular, as a comparative to other types of 1 and 2 year money. They really like that enhanced yield. So it's been really positive. We're very excited about the full launch to kind of hopefully replicate that success on a much wider basis.